Welcome to Module 5, where we focus on venture capital, often referred to simply as VC. So, what is venture capital, and why is it such a critical part of the funding journey for African entrepreneurs? Put simply, venture capital is a type of equity financing designed for high-growth startups. Unlike angel investors, who invest their own personal money, often between $5,000 and $100,000, venture capital firms pool funds from institutions and wealthy individuals to make larger investments, usually starting from $100,000 and scaling into the millions. When a VC invests in your company, they're not offering a loan that needs to be repaid. Instead, they're buying equity, shares in your company, meaning they become co-owners and usually take a seat at the table, literally. They expect a return on their investment, not through interest payments, but by eventually selling their shares during a major event, such as an acquisition or an IPO, ideally at a significant multiple. Most venture capital in Africa is managed by professional investment firms. You may meet them through accelerators or incubators, which are typically found in startup hotspots such as Nairobi, Lagos, Cape Town, or Accra. These firms operate structured funds, typically ranging from 10 million to 100 million, that are raised from family offices, pension funds, and development finance institutions, such as the African Development Bank. VC funds typically make 5 to 10 investments per fund and target high-growth companies in sectors such as fintech, agritech, renewable energy, and health tech, industries where significant problems exist and scalable solutions can deliver strong returns. Let's talk numbers. In Africa, seed funding rounds backed by venture capitalists typically start at $100,000 to $250,000. Series A rounds can reach up to $2 million, while growth stage rounds can exceed $5 million or more. Since local currencies fluctuate, VCs typically quote in USD or euros, even if the disbursement occurs in a local currency. That's something you'll want to plan for in terms of foreign exchange risk. In summary, venture capital is institutional money that targets startups with the potential to scale rapidly. Over the course of this module, we'll break down how the VC lifecycle works, what terms you can expect, and how to prepare your startup to attract and retain VC investment. VC lifecycle and stages. Let's take a closer look at how VC funding progresses over time. While amounts may vary slightly across African countries, the general pattern is quite consistent. We begin with the pre-seed and seed stage. At this point, you likely have a working prototype or MVP and some early traction. In markets like Nigeria or Kenya, that could mean processing a few thousand transactions through a pilot. VCs might invest between $100,000 and $500,000 at this stage, enough to refine your product, expand your pilot, or hire key engineers. Next comes Series A. This is when you've proven product market fit. Customers are paying, retention is strong, and your business model is starting to work. Funding rounds here typically range from $500,000 to $2 million, aimed at scaling operations, including launching into new cities, growing the team, and upgrading systems. If your growth continues, you will move into Series B and beyond. These rounds often exceed $2 million and can reach significantly higher amounts. At this level, investors are looking for solid governance, audited financials, and a clear path to profitability. The capital is used for larger scale expansions, such as entering international markets or building infrastructure. Finally, we get to follow-on rounds and exits. You might raise Series C, D, or even E rounds if needed. In Africa, exits typically occur through acquisitions by corporates, such as telecoms or FMCG companies acquiring high-performing startups. IPOs are less common but not unheard of. The key takeaway? Each stage demands more substantial traction. Seed investors want evidence of potential. Series A investors want clear economics. Series B investors want scalability. The timing of when to raise matters. Going too early can result in giving up too much equity, while waiting too long can lead to running out of cash. We'll help you determine the optimal timing for your business. Term, sheets, and deal structuring. When a venture capitalist, VC, wants to move forward, they'll issue a term sheet, a summary of the proposed deal. It's not legally binding, but it outlines the main points you'll be negotiating. First up is valuation, specifically pre-money and post-money. If your startup is valued at $2 million pre-money and the VC invests $500,000, your post-money valuation becomes $2.5 million. That means the VC now owns 20% of the company. Next is the equity stake and option pool. Most VCs require a pool of shares, typically 10 to 25%, to be reserved for attracting and retaining talent. This pool often comes from the founder's shareholding, which can further dilute your ownership. Then there's board composition and voting rights. VCs usually secure at least one board seat and may also include protective provisions. Essentially, veto rights over major decisions, such as selling the company or raising additional capital. We also need to discuss liquidation preferences and anti-dilution clauses. A 1x non-participating liquidation preference means the VC receives their original investment back before any remaining proceeds are shared. Anti-dilution terms protect them if future investors pay a lower price per share. The most common form in Africa is the weighted average formula. Another important term is vesting schedules. Founders and key team members are typically required to earn their shares over a 4-year period, with a 1-year vesting cliff. If someone leaves early, they forfeit unvested shares. This keeps the core team aligned over the long haul. Understanding these terms is critical. Even small changes, like a higher liquidation preference, can significantly impact your returns in an exit. In the next section, we'll walk you through the steps to prepare for due diligence, ensuring you're fully prepared to move forward. Due diligence and preparing for VC investment. Once you've agreed on terms, it's time for due diligence. The VCs deep dive into your business to confirm everything checks out. Here's what to expect and how to prepare. Start with your corporate documentation. Ensure your certificate of incorporation, shareholder agreements, and cap table are current and up to date. If you've already raised money from angels or received grants, these records should reflect that. Then, prepare your financial records. If you've been operating for a year or more, audited accounts are ideal. If not, accurate management accounts will suffice. Profit and loss statements, cash flow statements, and balance sheets. Be realistic with projections. On the legal side, confirm that all intellectual property is registered and that all required licenses are up to date. For example, a fintech in Nigeria may need a payment aggregator license. Ensure it's valid and up to date. VCs will also want market validation. Show contracts, letters of intent, or purchase orders. Metrics like monthly recurring revenue, MRR, customer acquisition cost, CAC, and retention rates are key. Proving real customer demand is non-negotiable. If you're a tech startup, have your product and technology materials ready. This could include access to your GitHub repo, technical documentation, or architecture diagrams. Many VCs bring in tech experts to assess code quality and scalability. And don't forget about the team. Share bios, LinkedIn profiles, and references for your founders and key hires. A strong, credible team can make or break a deal. As for your pitch deck, keep it tight, 12 to 15 slides. Focus on the problem you're solving and the size of the market, your unique solution and why it matters, traction and key metrics, revenue model and growth strategy, competitive landscape and go-to-market plan, financial projections and how the funds will be used, your team and advisors, how and when investors can exit. Finally, set up a data room with all the necessary materials, including your business plan, financial model, legal documents, cap table, product roadmaps, and any supporting market research. Be transparent. Address risks up front, whether it's currency exposure, regulatory uncertainty, or market competition. Demonstrating that you've thought these things through boosts investor confidence. Suppose your materials are well prepared and your team is responsive. In that case, you'll move through due diligence much faster and dramatically increase your chances of closing the round.